Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guests today are Brendan Payne, a Vice President and Director of National Sales Consulting with Delaware Life, and Jeng Chiu, a Vice President and Director of National Sales Consulting, also with Delaware Life. Welcome to the podcast, Brendan and Jeng.
Good to be here.
Glad to be here, Bob.
Great to have you here. Our topic for today is one of my favorite topics, estate planning. I'm eager to learn more, and our listeners are eager to learn more about some of the key estate planning strategies that they should be thinking about. Brendan, you want to go first?
Yeah, absolutely. My name is Brendan Payne. I've been with Delaware Life for about 4 years now on the National Sales Consulting team. I am a licensed attorney in Colorado, an LLM in taxation, and I've been in the annuity industry for about a decade as well. And my areas of expertise really are in the areas of estate planning, tax mitigation, working with trusts, selling businesses or ranches or farms, and how to do that in a tax efficient manner. So this is a topic that is really special to my area of expertise and something I enjoy talking about.
And Jeng, for the benefit of our viewers who may not be familiar with your background, do you mind sharing your bio?
Sure. I've been in business for about 24 years. My background is also in law and accounting. Started out my career doing a lot of fee-based planning, and I've spoken, just like Brendan, spoken at a lot of conferences on different advanced planning strategies. So excited to be here. Also a part of the National Sales Consulting team with Delaware Life for about 4 years.
Great. All right, Brendan, let's get to it. Let's talk about some of these key estate planning strategies that our listeners should know about.
Great. Well, estate planning off the top, estate planning is key for not just every client that we have, but every individual in the country, whether you have $500,000 or $5 million or $500 million or $500. It's key to the orderly dispersal of assets once someone has died. And everyone has wants and wishes for how their assets are to be distributed once they die. And having an estate plan in place is key to making sure those wishes are carried out.
Right. Obviously, things like wills and beneficiary designations, we'll get to some of those things, but a lot of times people focus on this notion of avoiding probate at all costs. Care to talk about that?
Yeah, probate is the legal process of distributing one's assets after they die. And probate being a legal process, it can be costly. There's legal fees involved. It can be time consuming. You have to go to a court and have your will or your estate probated. So there is a court process involved with that. And the courts have been backed up over the last several years with the pandemic. A probate process that can be very simple has actually now been extended in how long it takes to actually go through the process. So even very simple estates can take 6, 9, 12 months to be probated. And when that happens, that just means beneficiaries are having to wait to receive the assets which they are entitled to. And then finally, probate is public. It's a public record. Once assets are probated, you have the classic example of the nosy neighbor can go down to the courthouse, pull up someone's will that's been probated, and see what that person had for assets and to where they were distributed. So there are quite a few drawbacks to the probate process, but luckily there are some ways to avoid it.
Right. Jeng, any thoughts before we move on to some of the other topics?
No, I agree with Brendan. There's a lot of uncertainty. I think a lot of times, it depends on the jurisdiction. It's sort of a case-by-case basis based on where you live on the probate process. It could be very quick. It could be very, timely. It could be a long, drawn-out process. So I think what we're talking about today is just to give clients options, right? And that's the key, is to have a good conversation with them, figure out which items might be better for probate and which items you might want to avoid probate or minimize, some things that you might want to be going through probate. So I think this is the type of discussion we want to have, so the advisors could feel comfortable and be able to communicate to clients on what their expectations might be.
Right. So one of the key elements of estate planning has to do with beneficiary planning. Talk about that, Brendan.
Yeah, beneficiary planning luckily, for a lot of the accounts that we deal with, there is beneficiary designation already attached to that. So any type of brokerage account, any type of IRA account, qualified plan account, life insurance account, annuity account, even adding transfer on death instructions to a bank account. That's a way where you can add a beneficiary designation directly to that asset. And so what that means is when someone dies, as long as the beneficiary designation has been properly filled out, those assets can transfer directly to that named beneficiary and it completely avoid having to go through the probate process. So that ensures that the beneficiary is receiving that asset in a timely manner. And there's two types of beneficiary. I'm sure this is review for many people, but there's two types of beneficiary. There's a primary beneficiary, or you can have multiple primary beneficiaries. And they're the people who receive the assets first when someone dies. But there's also an equally important contingent beneficiaries. And they're kind of the backups to the primary beneficiaries. So if all primary beneficiaries predecease the owner of the assets, then the contingent beneficiaries step up and take their place, and they'd be the ones to receive the assets. So it's equally important to make sure you have both primary and contingent beneficiaries listed on any type of account where you can have a beneficiary designation. And in our industry, it's also critical, and this is probably one of the things that we see most often that's overlooked, is to check regularly to make sure that beneficiary designations are up to date. There's lots of life events, whether it's a marriage, a divorce, a birth of a child, a death of a spouse, a falling out with a family member or a friend, a building of a new relationship with a charity in terms of leaving assets to a charity, or a falling out with a charity. So it's critical to always be asking clients in annual reviews or whenever you meet with them that their beneficiaries are correct on all of these accounts.
And are there some tax traps that folks need to worry about?
There's always potentially tax traps involved with beneficiaries. One thing to consider is it's what's commonly known as the 50-50 beneficiary tax trap. And this would be a scenario, for example, where there's an individual, they're not married, but they have two children. And one of the children is, let's say, a doctor, and they're a high earner. They make $500,000 a year. And the other child is a teacher. They earn much less than that. Let's say they earn $60,000 a year. And the parent has an estate that they want to divide equally between the two children. And let's say that estate is made up, half is made up of qualified funds that would be fully taxable to the inheritor. And the other half of that estate is made up of non-qualified assets with a high cost basis that would be incur no taxation or very low taxation. If that parent was to equally split those assets 50-50 between the children, now the higher earner is potentially inheriting assets they may not want to inherit for tax purposes. It may be pushing them into a higher tax bracket, increasing their tax bill, whereas the lower earning child may be able to absorb those assets, those taxable assets, in a much more tax-friendly manner. So looking at not just dividing assets equally, but dividing them based on what the tax consequences would be for the person inheriting those assets is a key factor in beneficiary planning as well.
Jeng, any additional thoughts?
Yeah, I think Brendan makes a couple of really good points. The reason why you want to look at this on an annual basis or as needed basis is because, let's say Brendan mentioned you have the contingent beneficiaries. Maybe you had two kids and they were both married, and then one person now is single. So you have the person who is single might have a lower threshold for tax purposes, right? So maybe the married couple, and especially the lower brackets all the way to the top brackets, might have a much higher threshold to be in certain tax brackets. When it first starts out, maybe they were sort of equal, they made similar incomes, and then one person gets divorced, then something happens to their income, or they have lower thresholds for a certain type of tax bracket. So it's important. Also, for example, for the contingent beneficiaries, what states do they live in? So maybe you have one child but you have two children and they're contingent beneficiaries and they both make equal income, but one child lives in New York State and the other child lives in Florida, or one child lives in California, the other child lives in Nevada. So even a disparate state income tax could be 10, 15% difference. So you want to look at the type of asset. So for example, the person in the higher income tax bracket for the contingent beneficiary, you want the step-up basis assets. You want life insurance proceeds, because as we know, life insurance proceeds are not federal income taxable. And then for the child in the lower tax bracket, that's when you want perhaps to give them the IRD assets where they get taxed on a full basis. So I think it's a compelling argument to have consistent communication amongst the children. It's also a really good way to have those conversations with the next generation. I know a lot of advisors always talk about, I have a great relationship with my clients, but I don't really know their kids that well. And so talking about contingent beneficiaries and making sure the state passes those assets on as efficiently as possible, rather than going to Uncle Sam, you might want to look at how do you keep those assets and have the proper distribution amongst the family, even amongst the family with the disparate tax brackets. And those are good family conversations. I used to do client events and we call them family conversations. So it's another good way to have that meeting with the kids, as long as everybody is comfortable with that. And it's a good way to transition that business so that you make sure that not only are your clients protected, but their kids are protected, and you develop that relationship with the next generation.
Yeah. So the Secure Act changed the way beneficiaries might inherit an IRA and the distributions from those IRAs. Talk more about that.
It sure did. The Secure Act did a lot of good things for retirement planning, but I think the biggest negative that we can all agree on is that it eliminated the stretch IRA for the majority of beneficiaries. If we remember the stretch IRA, it was a way for a beneficiary to stretch the inheritance of an IRA over the beneficiary's life expectancy. They'd have to set up an RMD table based off the beneficiary's life expectancy. They always had the ability, they'd have to take that minimum amount every year. They always had the ability to take more or all of it in any year. And it stretched that taxation over potentially decades. And it was a very, very valuable planning tool. But with the elimination of that, we're left to try to scramble and come up with some ways to try to recreate the stretch IRA as best as we can. And there's no perfect way to recreate it as well as the stretch IRA did it, but there are some novel planning strategies that an IRA owner can put into place before they die that could potentially recreate the stretch IRA to a point. And I'll give you a couple ideas on that. First is using a charitable remainder trust. So instead of leaving IRA assets to a child, for example, leave it to a CRT that is in benefit of a charity, but names the child as the income beneficiary. So what happens is the IRA assets pass tax-free to the CRT because the CRT is a tax-exempt entity. The CRT pays out payments of a set dollar amount or set percentage each year to the child. And then whenever the child dies, whatever is left goes to a charity. So that sort of recreates a stretch IRA in that the payments are stretched over the life of the child, but it doesn't have as much flexibility as the stretch IRA did. Another idea would be to look at doing a Roth conversion during the IRA owner's life. So if the IRA owner is able to, from a tax standpoint, convert their traditional IRA assets into a Roth IRA, then there's no taxation involved with withdrawals or death benefit when they die to their beneficiary. So the beneficiary can look at those assets as simply a windfall, and whenever they do inherit it, it essentially becomes non-qualified money for which they can invest any way they see fit. A third idea, and this is specific to annuities, if you put an IRA into an annuity, many insurance carriers will allow for what's called a restricted death benefit. You might also have heard of control from the grave. And this is a way for the contract owner to force their beneficiary into an annuitization after their death that the beneficiary cannot change. So this would work well for clients who have concerns about their children who are beneficiaries, spendthrift concerns about them, that they might take a large lump sum windfall and act very irresponsibly with it. This is a way to ensure that the payout is done over a set number of years. And because of the Secure Act, those annuitizations are limited to 10 years. So those are just a couple ideas on how to try to recreate the stretch IRA. Really is, again, no perfect way to fully recreate it, but there is some planning that can be done around it before death to try to place some control on how beneficiaries inherit those death benefits.
Jeng, any additional thoughts?
Sure. I mean, I think Brandon made some really good points on, especially some of the higher income earners, and especially if they have large IRA assets, which they want to distribute over a long period of time. The other thing too is if you have clients with smaller IRA assets, maybe less than $1 million or whatever it might be, we want to think about their income distribution strategy. So, for example, a lot of times people talk about one of the most common questions is, where do I take my money out first? So it might say, well, instead of, a lot of people say, well, I'm going to take out the non-qualified money first and delay my IRAs. And that's why people have RMD issues and so forth, because they let that grow. Well, once you stop working, you might be in a lot lower tax bracket. So instead of doing it that way, you might want to take out your IRAs first and then leave your non-qualified assets, because they might get a step-up basis. So without the stretch IRA, sort of a very simple alternative would be to just change the order of your distribution for income plan purposes. Just take distributions from IRAs, capture the lower brackets, save your step-up basis assets for your beneficiaries, and then you don't have to worry about the stretch IRA as much if you're spending that down over 15, 20 years, right? At least capturing the lower brackets. So if you have large IRAs, I 100% agree there might be a lot of different strategies. As Brendan mentioned, very good strategies. If you have lower amount of IRAs, then you might want to think about your income planning distribution order and maybe your spend down strategy as well.
No discussion about estate planning would be complete without talking about the key documents that are required. Brendan, you want to walk us through those?
Yeah, any estate planning attorney you meet with, estate plan is made up of a number of documents. And there's going to be several key ones that are going to be part of any estate plan. And you're probably familiar with them: advance directives, power of attorneys, a will, those type of things. And most estate planning attorneys you go to, they're going to package those all into one fee when they're drafted. But if you have to have absolutely one estate planning document, the one that I would get first is the advance directive or the living will. This is a document that controls any sort of end of life medical instructions. And why this is so critical and why this is so key is because an accident could happen and someone could find themselves unable to communicate their wishes and having to rely on this document in order to make those key decisions. Or you could also find yourself in a situation where you're going into the hospital for a surgery that's pre-planned, and this document could be needed to make decisions in case the unexpected happens. And this document goes over what sort of life-sustaining procedures you'd want to have and how long you'd want those to be continued, what sort of artificial nutrition procedures you want to have and how long you'd want those continued. It also would include information about whether you want to be an organ donor, and critically, who the hospital can release information on your status to. So you can include a list of people who are maybe not your immediate family, siblings, close friends, colleagues, who can get that information from the hospital if they call and ask for it. Or you can include their contact information and have the hospital notify them. So this is really a key document that everyone should have. And the other thing to keep in mind on this is you need to have it in a secure location where trusted people know where to locate it. So for example, in my home, we have a waterproof and fireproof safe where we keep these documents in. My spouse knows where to find it in case it would be needed in any type of situation. After the advance directive, probably the second most important document is your will. And we talked briefly about the will earlier in terms of the probate process. But a will is simply a letter to the probate court stating how assets are to be distributed, and the person who's going to distribute those assets is the executor, or they also can be referred to as your personal representative. They're the person who is named in the will as the person who's actually going to physically distribute those assets. And the executor is usually a family member or a trusted friend or a colleague, Or for very large estates, it can be a professional executor, an attorney, a banker, an accountant, someone like that. And then they charge a fee for that. But if you've ever seen a will, even a very simple will, it's probably 10, 12, 15 pages, something like that. But the majority of the information in there is all boilerplate. Wills are drafted from drafting documents, and a lot of it is just boilerplate information that needs to be included. The meat of the will is going to be in that first 2, 3, 4 pages of it. That's going to name what specific assets there are, who's going to get those assets, and the terms of receiving those assets. And for the majority of people, if they're married, what they're going to state in their will is they're going to leave all of their assets to their spouse. There could be some situations where there's very specific assets, think collectibles, artwork, family heirlooms, one-off type things like that, that someone might want to leave to a specific person, and that would be noted there as well. But the typical situation is all assets go to the spouse, and then if the married couple has children, they would be essentially the contingent beneficiaries, and they would receive the assets if both parents are deceased. And for a lot of individuals, the children may not receive those assets outright. They may instead go to what's called a testamentary trust in benefit of the children. And testamentary trust just means a trust that's created by the terms of the will. And this is done in case both parents die and the children are still minors. Or in a lot of cases, if the children are still in their 20s or 30s. And again, this could be for spendthrift concerns. So again, an example from my own personal will, my wife and I have a 2-year-old son. And in our will, we leave all assets to each other, and then there's a testamentary trust. And the terms of the testamentary trust state that assets will be distributed to our son. 25% of the assets will be distributed to our son when he turns 25. Another 50% will be distributed when he turns 30. And the balance will be distributed to him when he turns 35. So that testamentary trust actually controls well past when he reaches the age of majority and into his 30s, just to ensure that he would be at an age where we feel comfortable with him acting responsibly with a large inheritance. And then finally, and really most interesting, and this has developed over the last 15 or 20 years, is what do we do with our digital assets? What do we do with our digital estate? It's very well founded in the laws of the probate laws of every state, how you distribute physical assets. But what do we do with things like our online banking or brokerage accounts? What do we do with our storage accounts where we could have thousands of family photos, or our email accounts where we have thousands or tens of thousands of emails and different documents on there? What do we do with our social media accounts, our Facebook, our LinkedIn accounts? Do we have instructions on how to turn those off or keep them on going in perpetuity? What about non-cash accounts, things like airline miles or hotel rewards programs? Are those, first of all, are those transferable per the terms of those programs? And secondly, there is some value to those. And how do we transfer those to beneficiaries? And then, two very, very new accounts that have popped up in the last probably 2 or 3 years. And these two accounts are the ones that are probably most likely to not be known by a spouse or by children, is how does someone access a cryptocurrency trading account? Or, and if you've watched a sporting event in the last 12 months, you've been bombarded with these commercials. How do you access someone's sports gambling account and get money out of there? So these are all very interesting questions that we have some answers to. We might not have some answers to through statutes and through case law. I mean, this is stuff that's really being developed right now. But the easiest thing to do is include this type of information either in the will or in a letter of instruction that's referenced in the will. And you can, and you literally have to leave, login names and passwords for your executor to access these types of accounts. And you can do that one of two ways. There are digital programs online that store logins and passwords, or you can take a very analog approach like I do. I have a notebook next to my desk where I write down all my logins and all my passwords to the different accounts I sign up for online. So it's important to leave instructions for your executor on how to access those accounts and what you want done with those accounts after your death.
That was so comprehensive. Jeng, I'll ask, anything to add?
Yeah, a couple of things. And I think Brendan did a good job with the overview of many different facets of both advanced directives as well as facets of a will and considerations that people want to think about. One thing I will mention real quick is on the advanced directives, you might want to think about having some kind of durable power of attorney or healthcare proxy, especially for non-traditional couples. You have a lot of people who live together, may not be married, maybe they're not the legal partner, whatever it might be. They just will not get married or whatever it might be, their choice. And you have to decide who's going to make those type of decisions for you. And a lot of times there's a legal aspect to it where, if it's somebody's girlfriend or boyfriend or partner, they might not have the legal basis to make those type of decisions, those medical decisions for somebody. And so that's a consideration if you do happen to have clients who are not married but would like their partner to be involved in some of those decisions. That's something you probably want to review. I think, like I mentioned earlier, Brendan, did a really great job in going over the different facets of a will. The most important thing is to talk to your clients and figure out what is really important that some specific person gets some specific item. And those are typically the things that you want to include in the will. When you think about it, is like, do I want to leave some kind of family heirloom to some special person? And then Brendan touched upon all the different other aspects that many people don't think about, like the cryptocurrency, like the airline miles and things like that. So I think the other aspect for advisors or financial representatives is to have that communication with your client's attorneys. A lot of times, advisors or financial representatives will tell the clients they're the financial quarterback of their situation. They're the quarterback. And as the quarterback, it's important to have that communication with your clients, CPAs or tax preparers, and also the attorneys. You have common clients. It's a great way to get referrals. It's also a great way to make sure that whatever you are doing from a financial planning standpoint is congruent with what the attorney is doing. So you want to make sure that the client's wishes are meant to be executed, and you want to make sure that the financial planning aspect and the legal aspect coincide and are working together. And so those are really good conversations to not only have with the client, but to make sure that you involve the attorney and maybe their tax preparer as well.
So I may be repeating myself, but no discussion around estate planning is complete without talking about the taxes that come with an estate. Brendan, you want to walk us through some of the basics and some of the planning opportunities there?
Estate planning often gets confused with estate taxes and estate taxes only. But we just spent the last 20 or 25 minutes talking about all of the important parts of estate planning, and we haven't even touched on estate taxes yet. But estate tax is a very interesting concept. It's a very unique tax in the federal tax code. And in fact, it's a very onerous tax if you're subject to it. It's a flat tax. It's a tax of 40% on your estate if you exceed the federal estate tax exemption amount. Now, luckily, the exemption amount is very high right now. It's at $12.06 million, so just over $12 million. And if you look at the history of the estate tax, go back the last 25 or 30 years, the estate tax has been the estate tax exemption amount has been a different amount just about every year. It's been as low as several $100,000. It's now at a high point. Actually, in 2010, because of a loophole, because Congress failed to act, there was no estate tax exemption amount. It was unlimited that year. And that was actually the year that George Steinbrenner, the former owner of the New York Yankees, died. And he was able to leave the New York Yankees and Yankee Stadium to his sons, valued at several $1 billion, estate tax free. So that was a good year to die if you were a very wealthy person. But if we look at the history of the estate tax, it's important to remember that this amount varies from year to year. And in fact, it's going to it's set to sunset, set to decrease in 2025. It's going to go back down to 5 million plus inflation. So I estimate that to be just about $6 million. So really cutting the exemption amount in half, more than half. And that would subject a lot more people to potentially to the estate tax. And it's also important to remember that this is just for leaving assets to non-spouses. Any assets that are left to a spouse are left estate tax free, and they don't incur any of this estate tax exemption amount. And married couples can aggregate their estate tax exemption. So a married couple together can leave more than $24 million to beneficiaries. It's also important to remember that the federal estate tax is at 12 million plus, but it depends on what state you live in, because certain states have lower state estate tax thresholds. So for example, Massachusetts and Oregon, that's $1 million. Minnesota is $3 million. Washington State is about $2.2 million. So if you're a moderate to high earner and you live in Boston, or you live in Portland, Oregon, and you own a home, just by the fact of owning a home, you're probably pushing up, if not over, the state estate tax threshold. So it's critical to not only look at the federal exemption, but also look at what state you're living in.
You answered the question that I was about to ask about the state estate taxes. So what are some of, before I move on, Jeng, anything to add?
No, I mean, I think Brendan covered it. It's there's about 17 states with either in the state estate tax or inheritance tax. So something to consider when people are evaluating their estate planning. And the other thing I will also say too is, as we know, the estate tax is a moving target. Depends on how the elections are and what type of revenue the government needs. There's all sorts of things that change all the time, right? So it's a moving document. It doesn't change. It's not a drastic change where people all of a sudden are surprised by it. Usually aren't surprises, but it's something to plan for. And just understand that it's a moving target. It might be 4 years, it might be 8 years, it might be 20 years before some of these numbers change, but they do change depending on the political aspect. And as we know, a lot of tax planning, both in income tax and estate tax, is politically driven. So something just for advisors to keep an eye on.
Yeah. So what are some of the planning opportunities here, Brendan?
There's a lot of planning opportunities when it comes to the estate tax. And just like Jeng said, the estate tax is not a surprise for anyone. So it gives us the forethought to plan for it. Let's start out with some basic planning strategies. So I always like to start with the easiest planning strategies first, and then we'll work our way up to more complex strategies. And the two basic strategies just center around gifting. There's two types of gifting. There's annual gifting and there's lifetime gifting. And annual gifting allows for anyone to give up to $16,000 per year to an unlimited amount of people every year. And that $16,000 is not subject to gift or estate tax, and it does not reduce your lifetime exemption of 12 million plus. So a simple example is there's a parent, and the parent has 4 children, and that parent gives $16,000 to each of those children. Well, the parent has now removed $64,000 from their estate in that 1 year. Let's say parent is married, so you have 2 parents and they have 4 children. They both give $16,000 to each of those 4 children. That's $128,000 they've just removed from their estate in 1 year. And let's say they do that for 10 years, or they do that for 20 years. And you can see how quickly that can add up. And let's add in grandkids potentially. You can see how quickly that can add up as a way to lower someone's estate or lower a married couple's estate to get under any sort of estate tax threshold or estate tax exemption they're looking to get under. Add on to that the lifetime gift. If you want to gift more than $16,000, you can do that without estate or gift tax. You just have to use part of your lifetime exemption. So that 12.06 million estate tax exemption, you don't have to wait till you die to use that. You can use that while you're living. So let's say a parent wanted to gift $1 million to a child in 2022. They can certainly do that. It just means their lifetime exemption is reduced by $1 million. It would now be 11.06 million going forward. And an important thing to keep in mind about the lifetime exemption amount is if it does get lowered in the future, that means people in the future would have less to work with if they wanted to do lifetime gifting. So there are some tax theorists out there right now who are saying that since the exemption is so high right now, this is a use it or lose it scenario for significant gifts. So what I mean by that is, if it's 12 million now and it goes down to 6 million in 3 years, you're essentially losing 6 million of potential gifts. So maximize your gifting right now, because again, some tax theorists out there think there's no way for the IRS to come back and audit you and retroactively tax you on that gifting you did prior when the exemption was higher, prior to the exemption being lowered. So certainly something to think about for ultra high net worth clients who have some estate tax concerns. Then when we get into more of the complex strategies, then we're talking about trust strategies. And probably the two most common trust strategies surrounding estate planning would be credit shelter trusts, also known as a bypass trust, or a CST or an AB trust, and an ILIT, an irrevocable life insurance trust. And chances are, since the exemption amount is so high right now, I would say there's a very good chance that you have not had a client walk into your office in the last 5 years with a brand new bypass trust or CST or ILIT. I bet there's a lot on your book of business from 10, 15 years ago, but they probably haven't come in with a new one because there hasn't been the need to do that. Because the exemption amount has been so high, it doesn't capture as many clients as it had in the past. And in fact, I was talking with an advisor last year about this when it looked like Congress might take some action and lower the exemption amount prior to 2025, when there was a lot of talk about the Build Back Better plan last fall. And he asked me, what type of new planning strategies are going to be developed to help mitigate estate tax? And I said, it's not going to be new ones. We're going to go back and play the greatest hits, like CSTs and bypass trusts and ILITs. And just briefly, a bypass trust is a way to essentially create is for a married couple. When one spouse dies, the assets of that spouse break into two trusts. There's an A trust, which is the marital trust for the surviving spouse, and a B trust, which is the bypass trust for the children. And the B trust is filled up to the exemption amount. So you fill that trust up to 12.06 million. So you use up all of that first spouse's exemption amount. And whatever is left over goes into the marital trust. And let's say this is a very high net worth couple. Let's say they have $30 million in assets. So you put 12 million in the bypass trust, you put 17 million into the marital trust, and the surviving spouse is entitled to income from the bypass trust plus income in principal from the marital trust. And then once the surviving spouse passes, whatever's left over gets passed to the children as well. So this was a strategy that worked much better when the exemption amount was lower because so many more clients were subject to this, but it certainly still has application today and could have application in the future. And then finally, an ILIT. I'm sure a lot of us are familiar with an ILIT, but an ILIT is a way to set up an irrevocable trust that owns a life insurance policy, and the life insurance policy pays out a death benefit outside of the client's estate to children. And this is a way to have a large death benefit inside of that trust, pay out to children, and be both income and estate tax free. And let's say you have, just to give you an example, let's say you have a parent and they have 4 children. What the parent is able to do is gift up to $16,000 a year times 4, so $64,000 for each one of those children into the trust to purchase the premium on the life insurance each year. And that, so you get 2 benefits there. You're removing assets out of your estate to pay the premium, and you've got this large death benefit. Let's say the death benefit is $5 million, for example, inside of that trust. And whenever parent dies, that death benefit is not counted against the parent for their estate because it's in an irrevocable trust. So it goes estate and income tax free to the children because, of course, life insurance is always income tax free, the death benefit on life insurance. So those are some of the more complex strategies. Again, all of this takes forethought and planning, but there are quite a few strategies out there to help mitigate the estate tax.
Yeah. So, Jen, before we move on, any additional thoughts and commentary?
Yeah, I think overall, I think Brendan did a great job doing a comprehensive overview. The only thing I will mention too is that when you look at gifting, a lot of people are like, okay, annual gifting, what should I gift? And you kind of want to think about that because you're probably better off considering gifting cash, because if you gift appreciated assets, then the person inheriting those assets will get a carryover basis. So, in many situations, you're probably better off, especially if you have highly appreciated assets, to gift cash, because if you were to pass away, some of those non-qualified assets will get a step-up basis. So when you do your annual gifting, you might want to think about which type of assets to gift in the annual gifting. And a lot of times cash is better than highly appreciated assets. And I think that's important too, because you rather have a potential step-up basis rather than passing on those potential taxes to your beneficiaries. And then if they ever sell those assets, they would not get the step-up basis upon the parent's death. So even when you're gifting, you might want to even think about what types of assets. Typically it is cash, but if they say, oh, I'm just going to give you my stock, and then the kids sell the stock, then they would have to pay taxes, where the parents kept the stock in their estate, gave them cash, and then eventually if they passed away, they might get a step-up basis in the stock. So even those minor sort of considerations could have tax consequences.
Great comment. So there are obviously some special circumstances that people need to think about with regard to estate planning. Brendan, you want to cover some of those items? A
couple special circumstances that we see quite often. 1, special needs trust, and 2, charitable planning. A special needs trust, and this is probably the most common type of trust that we talk about with advisors and with clients. It's a type of trust that benefits a special needs individual while still allowing that individual to qualify for governmental benefits like Medicaid and long-term care benefits. So in order to qualify for Medicaid and long-term care benefits, someone has to essentially be in poverty. They can only earn about $2,000 in income. They can only have about $2,500 in assets. So if they were to inherit a large sum of money or assets from a parent, for example, that could disqualify them from Medicaid benefits, which would be disastrous. So kind of the example that I like to use is there's a parent and they have a child, and the child is disabled, and they qualify for Medicaid benefits. And the parent, during the parent's life, they're able to support the child. Maybe the child lives with the parent, maybe the child can live independently, but the parent really takes care of all their needs. Then when the parent dies, let's say the parent has $500,000 in an IRA. If the child wasn't to inherit that, first of all, they don't have the capacity to manage that money. And second of all, it would knock them off of their governmental benefits, which would be a catastrophe in that situation. However, in that situation, don't leave it directly to the child, leave it to a special needs trust in benefit of the child. So that $500,000 goes into the trust. The trust is then managed by a trustee. Let's say that's another sibling or a trusted friend or another family member. And the trust and the assets in the trust can be used on an as needed basis. So let's say there's a large piece of medical equipment that needs to be purchased one year, for example. The trust can do that and supplement the needs of that special needs individual while that individual is able to maintain their governmental benefits. And what we see a lot of times is an annuity can be a great funding vehicle inside of that trust. So a special needs trust is a type of irrevocable trust. And irrevocable trusts have compressed trust tax rates. It only takes about $13,000 in earnings to trigger the highest marginal tax rates inside of an irrevocable trust. However, if you invest those assets in the special needs trust into an annuity, you get tax deferral on any earnings in there. And anytime a withdrawal needs to be taken, it's going to be paid out for the benefit of the special needs individual. Therefore, it will be taxed at that individual's tax rate, which would most likely be zero. And you don't have to worry about the 10% pre-59.5 penalty because that individual qualifies for the definition of disability. So it really is, an annuity can really be a win-win situation in a special needs trust scenario. And the other type of planning we see quite a bit of is charitable planning. Many clients want to have either all of their estate or a portion of their estate go to a charity, whether that's their alma mater or the United Way or the Salvation Army or their local church or their local youth sports organization, whatever the case may be. They want to carve out some benefit for that organization. And the easiest way to do that is just name them as a beneficiary on your accounts. But if you do a little forethought, little planning ahead, you can benefit the charity and get some tax deductions or tax breaks up front. Using a charitable remainder trust, which we talked about briefly before. A charitable remainder trust, you can donate an asset into a CRT, get a tax deduction for that donation. And if you donate an appreciated asset, you don't have to realize the appreciation on that asset once it goes into the CRT. So there's two main tax benefits to using a CRT for your charitable planning. And with a CRT, as I mentioned before, an income stream is paid out back to the grantor or to an income beneficiary. And when that person dies, whatever's left over goes to the charity. So there certainly are some very valuable planning aspects when it comes to charitable planning as well.
Jeng, anything to add?
I'm going to cover most of it. I think the only thing I will mention that we haven't really talked about real quick is just, be careful when you name the trustee. You want to have the long-term intermediate goals of what you want to accomplish. So, for example, you might name the trustee and 15 years later, they went to Europe and retired in Europe. Can they still be able to do a lot of things that the trustee is supposed to do? So you just want to be careful when you think about who you name as a trustee to make sure that they could be as involved as you want them to be involved, and what mechanisms that if you have to change the trustee are available to you. Because life changes, as we know. You might name the trustee when they're 40 years old, and when they're 65, they decide they want to live somewhere else, which is not local, and it might just be a lot more complicated than you originally thought in terms of what you want to accomplish. So those are the little practical things that people want to think about, even naming a trustee, naming the executor, those type of things where you just want to have some ability to understand what's involved and what the intermediate and long-term goals are as well.
Yeah. So one follow-up question for Brendan. Obviously, with a charitable remainder trust, it can be structured in numerous ways as a CRAT or as a CRUT, or any thoughts about what kind of working knowledge an advisor might need to have about these different structures?
Charitable remainder trusts are very complicated vehicles. Certainly, an estate planning attorney is needed to draft them. Like you said, there's CRATs, there's CRUTs, but the most flexible one is called a NIM CRUT. And this is a type of trust where you get all the tax benefits I mentioned before, but the flexibility comes with the payout amount. So what is paid out to the grantor every year is the lesser of a set percentage or any income generated in that trust. So it's a flexible payout, but it also can change year to year. And now you got to kind of picture who is the typical client that's going to have the means to be doing this charitable planning, and B, need a tax break, and C, set up a CRT. It's probably a very wealthy individual, a high net worth individual. So a lot of times these individuals don't necessarily need or want that income coming back out, because when that income comes out to them, it's taxable. So what we see quite commonly with a NIMCRUT is, again, using an annuity inside of it. Because if you place all of those assets in the NIMCRUT in an annuity, it's tax deferred. And if you don't take a withdrawal, you have no income. Therefore, there does not need to be any sort of payout to the grantor. So, excuse me. So that tends to be a very beneficial strategy for those types of clients.
Right. So the last thing I'd like you to address is something called IRD, or income with respect to a decedent. What do our advisors who are listening need to know about that?
IRD comes up when typically around, the most common time it comes up now, and I'm sure Jen can add some color to this as well, is when someone dies and they're in RMD payments on a qualified plan or an IRA, and they hadn't taken their RMD yet for the year. So let's say their RMD for the year was $10,000 and they hadn't taken it yet, and then they died. Well, that RMD payment is going to have to be paid out to the estate. It'll get added onto the estate tax return for that year. And it's essentially owed by the decedent. It's not that RMD payment, that $10,000 cannot be inherited, so to speak, by the beneficiary, like the balance of the IRA can. So that can be a kind of a got you situation for some beneficiaries when a client dies mid-year and they haven't yet taken an RMD.
Jeng, any additional comment
on
that?
Mostly it's retirement assets, right? So basically, the client was able to take a tax deduction and no taxes were paid. So when the ultimate beneficiary receives it, usually not the spouse, because obviously the spouse has different mechanisms, but usually the kids who receive those IRD assets, then when they inherit those, they're going to have to pay taxes on that. So I think it goes back to the whole contingent beneficiaries idea of who should inherit the IRD assets. And if you have two kids and they're in disparate income tax brackets, you want the person who is in the lower tax bracket, because that's going to be taxed at the ordinary income tax rates. So those are the things that you want to be, and then I think it also goes back to the discussion we had earlier about, do you want to spend down your IRD assets? Do you have step-up basis assets, which you might want to keep till later on? I mean, we've heard stories about people passing on generations of stock. People have been passing on, there's some stories of people who've been passing on Apple shares, into two generations now, right? So I think it goes back to the holistic financial plan. And I think that's the most important thing when we have these conversations, the entire series, is that estate planning should not be looked in a vacuum, just like taxes should not be looked in a vacuum. It's not just, okay, today we're going to talk about taxes, next day we're going to talk about estate planning. But it's really, when advisors look at these topics, it's about how do all these topics, how are they all integrated? How is your tax strategy, retirement strategy, estate planning strategy, how are they all integrated? Because there are both federal taxes that's involved, there's financial planning aspects, there's estate taxes that's involved. And so IRD is the perfect example of something that's estate planning driven, but also federal tax driven as well.
Well, gentlemen, we've covered a lot of ground. Anything that we missed or anything that just bears reemphasizing before we wrap up?
This is really just scratching the surface of estate planning. We've had a long conversation today, but it goes much deeper than this. And the one thing that might disturb clients is whenever they sit down with an estate planning attorney to get these documents drafted, they spend an hour or an hour and a half essentially talking about the client's death or upcoming death and what's going to happen after their death. So it can be an uncomfortable conversation, but it is something that that we need to bite the bullet on and make sure we get all of these details figured out.
Yeah, I mean, from my perspective, I always talking to advisors, their clients come away with a great deal of peace of mind and ability to sleep soundly at night, knowing that their estate plan is well documented and it will do what they want it to do. Well, with that, I want to thank you both, Brendan and Jeng, for chatting with us today. I greatly appreciate you sharing your knowledge and wisdom with our listeners. Thank you.
Great to be here. Thanks.
Appreciate it.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.